One of the fun parts of my business is when it overlaps with friends. And one of my good friends is also one of the leading wealth manager people. I don't even know what the heck he does with a phenomenal company, Miracle Mile Advisors. Dimitry Farberov, I've known him and his family for a long time, 10 years or more at least. And I know he's been in this business educating people on wealth growth and wealth management. Dimitry, thanks for taking time with us today.
Absolutely. It's my pleasure. Really nice to reconnect, Bill.
One of the problems that my clients come with time to time is as a result of an inheritance, they come into some money, maybe for the first time in their life. Many of my clients never owned a house and now have proceeds from a home or an inheritance. I know that you in the past have had some pretty interesting education tools to help people learn. What are some of the key things people need to do in order to understand what their responsibilities are, what the goals are regarding perhaps newfound wealth?
Sure. It's a great topic to talk about because really the center of my client base are clients who have inherited money through transition. So it's whether it's liquidity planning, selling of a business, inheritance, divorce, or simply going from retirement or from working a full professional life into retirement. And it creates a set of challenges that most of these folks have never faced. And more importantly, they haven't had the need to have a team of trusted advisors. They haven't cultivated that group. And now all of a sudden they have to deal with money, which is for anyone the most emotional, sensitive topic in their lives. And generally in this case, after inheritance, they're coming into money where after a period of potentially emotional volatility. And they come into this money, they don't know what to do. And typically what happens is some friend points them out to some banker somewhere and they're being sold things. And so it's a very difficult time. And so the most important thing when someone comes into money is to interview a series of advisors, right? Find someone who you trust, both potentially on a demographic level, someone who could communicate both with you beyond just money, just on a personal level, but also can communicate with family members. I often have found in my practice that inheritance, especially of a significant sum of money, creates a lot of rifts in families that didn't exist, or perhaps were brushed under the table, but all of a sudden creates responsibilities for people who aren't ready to handle them, and then you have a lot of issues centered around that. So trusted advisors are key, I think, for anyone in life. For whatever we do, coaches are incredibly valuable. And so that's really my role. I mean, yes, we do investment management, we do risk management, we do estate planning and tax planning and so on. But the number one centerpiece that kind of really coalesces all of those things is psychology around money and how to deal with money when we have so many things thrown our way, the primary of which is human emotion.
Yeah, I think in any endeavor in life, growth or transformation, you have to first start with your mindset, right? And I know I've had many clients who, they were living very modest lives, hand to mouth financially, and all of a sudden mom or dad or somebody passed away and they have $500,000, $1 million, $2 million. We call it life-changing money. Now, it could be life-changing for good, or it could be destructive and painful as well. And so having somebody to help coach you through the process is really critical. What are some of the things that you find people do that help them kind of grow? Are there any particular books that you recommend, or particular programs, or particular thought leaders, or is there any tools that you see consistently help people grow a money mindset that's productive rather than just be overwhelmed with it?
Sure. It all depends on the individual, where they are in life and what their history with money is. And if someone's an entrepreneur, a go-getter, that's one element that would benefit from books and would benefit from the Tony Robbins of the world. There are a lot of great resources there. When it comes to someone who maybe is in their early 20s or 30s and has inherited money from parent or grandparent, that history around money may not have been formed. And there, I generally recommend a book it's out of publication now, but you can still get previous series. It's called The Truth About Money by Rick Edelman. I've personally enjoyed it. It's about 500 pages. Every page is a different chapter on different topics around money. Doesn't really go into psychology as much, there's there's another book. I believe the author is Tony Housel, but it's Psychology of Money. It came out a couple of years ago. I've personally really enjoyed that book. I think it applies to everyone. But the reality is, if you're someone older and you're in your 60s, 70s, and you've got a history of dealing with money or lack thereof, your money psychology has really been already ingrained so deeply inside of you that I don't think a book is going to solve those issues. It can give you some ideas to understand what questions to ask an advisor, but ultimately that's where you want an advisor to be able to counsel you.
One of the common experiences I have is customers who inherit money. To date, their only real advisor was the teller or maybe the assistant manager at their local bank branch. And so they'll walk in with $500,000, $1 million, and those banks are just too glad to say, oh, great, we'll sell you a bunch of our securities. And not to disparage, though I love to disparage Wells Fargo, Chase, Citicorp, Bank of America. I think they are all evil corporations that work against their customers and are not deserving of our trust. I know you can agree with that, so I'll just let that be my opinion. But when I see customers come back with very expensive securities, commissions, the same money market fund or the same mutual fund that would be very low commission, being charged a high commission rate, and they don't realize that if you lose 3, 4, 5% off the top, it's hard for your money to grow over a long period of time. And so, to me, I would say, well, what was the strategy here? What was your thinking when you gave this guy $500,000, $1 million? And the answer is, I don't know. They're the bank. They're supposed to have it. So what does that intake process look like for you? I mean, obviously, I know that's not how you operate. I've seen your education. I haven't seen the actual mechanics. What's the intake look like? How do you, when you first meet somebody, obviously you get paid as soon as the money's deposited. We all do. But there's a time and a place for everything. What does it look like when you start that relationship with somebody at the very beginning?
Sure. Well, interestingly enough, I don't get paid when the money is deposited. The way a fiduciary infrastructure works is we get paid over time, right? We get paid assets under management. And so the incentive is to keep these assets here for a very long time and to grow them as much as possible. So both sides benefit. Obviously, the client disproportionately so as the money goes higher. One caveat. Banks, yes, there's a profit motive, and historically the commission driven model has created a lot of basically disproportionate benefit to the banks and the ultimate client. Some benefited from this interaction, but ultimately there was no fiduciary relationship, and as a result, right, the commissions were paid right away, but the risk was ultimately borne by the client. And we all know clients or the markets are volatile. And as soon as there's volatility, clients will almost always make the poor decision, sell at the wrong time. They were sold either directly or indirectly based on past performance. And of course, we tell them, well, past performance doesn't guarantee future results. That's back to market psychology. You show someone a fund that's up 20% over the last 20 years, no matter what you tell them about this, the lack of clarity around the future, they're going to assume that they're going to earn 20%, not realizing that there's tremendous volatility around those returns potentially. And past 20 years of capital markets may completely be the opposite in the future. So our approach, is all about transparency, right? So we don't talk, I personally don't talk about returns. So when I meet with a client, the first couple of meetings that we have is all about understanding their relationship with money or lack thereof, and who are the decision makers when it comes to making money decisions. From there, we create a transparent balance sheet and cash flow analysis, and that helps me understand what their ability and willingness is to take a certain amount of risk. It helps me understand what recommendations, how to structure a portfolio, whether they should be even in a portfolio, right? I have clients who tell me X, that they want to grow at certain levels, but they don't have the ability to do so because the next recession that comes and the next time their portfolio is down 20, 30%, based on their desired asset allocation, they're going to be stuck. and they're going to sell at the worst possible time. So understanding that for me is a incredibly helpful tool to then communicate to them and allow them to come to the conclusion that I believe that they need to come to. And from there is when we start the dialogue about, all right, what's the best use of the money? Of course, this is all rooted in a conversation around their goals and experiences first. Now, where do you want that money to go, right? Who's that money for? If you're in your 70s and you need cash flow, that's one approach. If you're in your 70s and you want this money to go for your grandkids or great grandkids, it's a completely different approach to money. And so those conversations drive the discussion, and every meeting is centered around the statement. I call it the statement of financial condition, right? Where are you today? How is your money done? But ultimately, where is your money going? Very few of the discussions ever center around how am I doing relative to X index or Y index, because frankly, it's irrelevant. I mean, we all want to compare ourselves to the house next door, but ultimately you live in the house that you live in, and you're either happy or you're not, and either satisfies what your needs are or you're not. If you're looking at the neighbor, you're always going to be unhappy. And frankly, those clients are not good fits for me. And hopefully we recognize that at the beginning, and we simply don't work together. There are plenty of great advisors elsewhere at other firms that will sell you returns, and some will actually accomplish them, whether by luck or through skill. And great, that's a personality type. But the clients that are inheriting money and don't have that psychology of a speculator, those are the ones that really enjoy working with me, and vice versa.
Obviously, one of the keys that's unstated, but I'm going to state it since we're trying to educate ourselves here, is that it doesn't matter just what happens with your money over time. It happens what happens with your money over time after taxes. Yep. Because there's a big difference between a 20% return that's taxable and a 20% return that's not taxable. There's also a big difference between 20% return when you're making other income in a higher tax rate versus 20% when you're maybe at a lower income stage of your life at a lower tax rate. So how does the process enter into it? Do you work with outside accountants? Do you work with your clients' accountants? Do you bring in the people on your team? How does that get integrated into the strategy decisions? Right.
It's a great question. I'll give you a case in point that just happened earlier this week. But just broadly speaking, I vetted personally within my Rolodex. I've vetted hundreds of accountants and trust attorneys and investment bankers, because and corporate attorneys. Those are the four individuals trusted advisors that we work with most. And so I understand, what their fees are, what their approach is, what their psychology is, who their target client is, what their personality is. So when the client is large enough and doesn't come in with an advisor already that helps them with certain needs, I'm insured to build a team around that. And I build the transparency. I serve as the financial quarterback. That said, our planning process is so detailed that I probably know more about their clients' tax situations, their tax liabilities, and so on, their state liabilities perspective, and so on, than their advisors do. So I count on their advisors, meaning their CPAs, the trust attorneys, and so on, to execute the documents. But in terms of the analytics and preparation, we do everything in-house. And I get them to the point where, okay, here are the documents you need to present to them so that they can execute these on your behalf and ultimately verify, our records, because sometimes, there's some investment out of left field that I'm not aware of, and so on. So that's what the CPAs do. So case in point, I have a client who's a producer of a very popular show, and his success has really taken off over the last couple of years financially. And so realistically, he's in the 53% state and federal and state tax bracket. And so we do a number of different investments for him, but the core of his portfolio is a broadly diversified portfolio of stocks and bonds, mostly stocks, given his age. And he came to me. He's always being sent by friends and family different types of investments, right, that might be interesting. And he brings them to us for us to vet. An investment, and I bring it up here because your background in real estate is someone who is a very successful home flipper, right? And so he takes outside money, and he has historically returned 12% returns on an annualized basis for his co-investors, right? But those investments are taxed at ordinary income for this individual. So I asked him, well, I explained to him that while this is an interesting 12% is an interesting way to diversify your liquid portfolio, right? But after the 53% tax that you're going to get hit with, you're going to get paid less than a bond would. And now you have an illiquidity factor. Now, he has a retirement account, so the conversation will be centered around whether we can potentially do that in his retirement account. And that might make sense. For the clients in the high tax bracket, the last 2 decades have not had the opportunity that currently we have in bonds, where you can get through municipal bonds in the highest rated municipalities, a 4%, 4.5% yield on a tax equivalent basis. That's 8+% with relatively little risk. So again, it depends on what one's needs and goals are, but we always evaluate taxes as a primary driver to both new investments as well as how do we, where do we take cash flow from, right, from old investments.
So obviously, and I think that explanation makes clear why it's so difficult for investments in this environment, because the wealthiest people are saying, well, why would I invest in anything that doesn't get me at least an 8% taxable return guaranteed, because I can be guaranteed 4% or 4.5%, tax-free of state and federal. And that is what creates problems for people. And here you're saying, well, it's a 12% investment. To me, as a real estate investor, 12% is a great return, but I also know it's a very volatile business. And so sometimes it sounds like a great investment opportunity. When you break it down, that's great as long as housing prices continue to go up. But if housing prices drop 10%, maybe you have a 2% return. Maybe you have to sell it at a discount to get out of it quickly. So it's not such a simple thing, some of these alternative investments. So when people think, at least when I think of Miracle Advisors and the industry that you're part of, we think of traditional stocks, bonds as the breadth of what you offer. But I know there's more and more non-traditional investments that are packaged in traditional ways, REITs and things like that. Can I describe maybe the smorgasbord or the buffet of options? Not to say that you're going to present them all, but just give me the range of options so that nobody's thinking of you as just stocks or bonds in major companies.
Sure. So I'll start from the most conservative, and everything is an investment, including the U.S. dollar, right? So if you're sitting in a cash money market right now, our clients are earning over 5% right now in basically a treasury, so state tax-free money market. We'll consider that the most short-term conservative investment. You got bonds, both taxable and tax-free, and then you have your stocks, and within the stock universe, obviously, there's a plethora of different asset classes and geographies and so on. So it's incredibly important to know what you're invested in. Outside of those markets, you have the liquid alternatives, and so that includes commodities, that includes publicly traded REITs, includes some trend following, and so on, that ideally have a less correlation with stocks and bonds. And in this environment, in a higher inflationary environment, tend to, or historically have done better than stocks and bonds in the short term. So those are liquid alternatives. More recently, it's become incredibly popular to invest in credit funds that these private equity firms have launched, and they have been bringing in tremendous amounts of money. A private credit fund is essentially lending to middle market companies that are cash flow positive, that have strong balance sheets, have strong growth, and so these private equity firms or their lending arms sometimes they co-invest. They invest in the equity. Company needs to raise capital. Historically, they would go to banks due to regulations and really the time it takes them to underwrite some of these. They don't do these type of loans anymore. They've kind of exited the market. So step in private equity companies, we all know them, the Goldman Sachs, the Apollos of the world, Ari's Capital here in Century City. And they offer these companies basically a prime plus a 5% margin. So right now, and they take a little bit of leverage, and so now they offer clients, anywhere after fees and so on, about 10% yield on assets that are collateralized. They're extremely well diversified, and what's unique about the lending, the underlying, is that these are short-term loans. They're 1 to 2 year obligations, so you don't have the interest rate risk that traditional bonds do. So it is an interesting option, but again, taxes are an incredibly important factor. My issue with those investments is whenever you have a flow of money coming in to these institutions, the underwriting quality becomes poorer and poorer, and eventually something blows up, especially when you have interest rate volatility. So it's incredibly important to know what you're invested in, because at some point in this cycle, many funds will blow up, and that can create a cascade of illiquidity for someone who might need that liquidity. So these are more illiquid investments, although there are some ways to get out on a quarterly basis with select funds. Now, beyond that, you have your real estate investments, you have your venture capital, you have your angel investments. These are even more liquid and generally have a longer horizon, 7 to 10 year lockups, but have much better return perspective. So you're not looking at 10% returns, you're hoping for 15 to 25% returns, obviously with significant amount more risk and illiquidity. So that's the general spectrum, and it's generally speaking, for anyone with assets, liquid assets under 2 million, it's not worth considering those investments. When you get above that and you get some complexity, that's when, with a trusted advisor, who is a fiduciary, that's the key. You don't want anyone selling these investments that's going to be earning commission on those investments, because now they're not in your corner, right? And ultimately, they're collecting fees, the management company is collecting fees, and that's eating away at your returns, but you have all the risk. So that's an incredibly important factor to consider. As you go to these banks, you're going to be given hundreds of these options. They all are going to look good. And I'm a CFA, chartered financial analyst. I've been doing investments on a personal, professional level for over 25 years. I can sit through 100 of these presentations. It's very, very hard to decipher which of these is going to go bust. They all sound good. They all have great pedigrees and backgrounds and underlying investments, but they will go bust at some point, some of them.
It's kind of like when you're in a Facebook group on a business thing I'm working on, and the guy's pitching cryptocurrencies. It's like, the guy's making 10, 20% of the commission selling you the currency. There's more money in that than there is in the actual, and they're just always churning the next deal, and so be careful of that. Well, look, I know I've had a great opportunity here to talk quite a bit, and I appreciate your generosity, your time today. Just want to wrap up and point out, if you're interested in more with Dimitry, Miracle Mile Advisors is the company, miraclemilesadvisors.com, and there's a picture. There's a little eye candy for the ladies. Dimitry Farberov is a very close friend. I've watched him grow in this industry, and I think the thing that has always impressed me is his focus on helping his customers learn and hopefully make the right decision on their own with his advice, rather than telling people what to do. So I don't know if someone want to get in contact with you. There's the contact me button, and that goes to an email. So there you go. Easy way to get in contact with them is just hit the contact me button. And Dimitry, thank you so much today for educating us on the relationship with a financial advisor, and with you personally. Really enjoyed your time today.
Thanks, Bill. See you around.